Hi, I'm Ross from Coombsmith Property Accountants, and we're obviously just going to look at the new announcements they threw in the budget. Their trust tax rate is going up to 39% from 1st of April 2024. So we're just going to have a quick look through what that really means and what it affects for you. So just skipping through. So obviously this is just some general information. It's not specific advice. So come and see me, have a proper meeting with me if you want to get some specific advice about this. But what we're looking at is the big problem coming up. Say you've got, $1 million profit in a company. You make a big profit. You pay 28% tax rate for a company, so you pay 280,000 tax. We then want to do dividends out. So normally we would do dividends out at 33%, and that means it moves the profits from the company through to the individuals. We pay the extra 5%, which is dividend withholding tax. We ended up getting really the ultimate tax rate at the moment, 330,000. If Labor stays in and this rule stays in, from the 1st of April 24, we're going up to a 39% tax rate. So really important, if you've got profits, if you've got companies looking at those dividends before 31st of March 24, and most likely, if Labor stays in, we're going to declare dividends to get all those profits out at 33%, because otherwise, if we wait until the 1st of April 24 after, it's going to be, in this example, 390,000. So we've straight away lost $60,000. That is a lot of money. That is a lot of extra tax to pay. Just that real quick thing I wanted to get across is, if you've got companies, you want to be looking at doing your dividends 31st of March 24 or before, if this rule stays in. If you've got some big profits from property trading developments, potentially can we move it forward so that it's in the 31st of March 24 year and we're only taxed at 33 rather than 39? It also shows with this example how important it is to have trust or look at your overall ownership. If you got some big profit like $1 million, like I say, paying 28% tax, $280,000, everyone thinks that's awesome, but it's only an interim tax. Sooner or later, you got to get it out. So you get those dividends out. At the moment, trust 330. If you had an individual shareholder, you'd be at 39%. Again, losing $60,000 for nothing. Really important to think through that. If you want to know why do we need to declare dividends, why is it so important, hang around for the next 5 or so minutes and I'll go through that as well. So this is a standard company balance sheet. Just a real example for a PowerPoint presentation. We've got assets. We might have banks, some accounts receivable, debtors, some fixed assets and other assets. Then we'd have our liabilities, our overdraft, our creditors, GST, income tax, loans, hire purchase, all that sort of things. Well, what you don't want to see in your assets is you don't want to see shareholders' current account. So say, for example, we've made $1 million profit. We've paid our 280,000 of company tax at 28%. And as shareholders, we've taken 700,000 out of the business. At this stage, we haven't declared dividends, so it's not our money. The company is actually loaning us $700,000 that we're not really entitled to that as shareholders yet. So from a tax point of view, we've got an overdrawn current account. We have to charge interest on that overdrawn current account. The rate that IRD deems that we must charge interest at is 10.39% at the moment. So there would be 72,000 of extra income to the company in this example. If we're at 33%, and note that this could be going up to 39% ultimately with the trust tax change, that would be 24,000 extra tax for absolutely no reason at all. The other problem is if you've taken out the $700,000 and you haven't done dividends, it's an asset of the company. So if the company was sued tomorrow, you would have to pay back that 700,000. So your company normally has limited liability, but by not declaring dividends and having that big asset of a shareholder's current account, you're putting all that money at risk. It's still the company's money. It is not yours. The company goes bust, you're going to have to pay back that 700,000, or your trust is going to have to pay back that 700,000. So for companies, we've all got risk. Things can go wrong. Really important to regularly put through the dividends. So we move those profits to shareholders. The shareholders can then take the cash and go off and pay for their personal house, their holidays, whatever they might be doing. So yeah, to me, really important to think about what this 39% tax change is going to affect. Think about if Labor stays in, dividends 31st of March 24 or before. And also we just want to be regularly doing them anyway. We don't want an overdrawn current account. It is a real bad thing to have it in there. Like I say, paying extra tax, this example, 24,000 for no reason, plus you've got the risk of the company sued. Keep an eye out on our Linktree. I'll put it in the comments as well. It's got a lot of free information. On the 29th, we've got our webinar all about provisional tax. What happens if you've late paid tax? Distributions, dividends, interim tax, the 28% that we've been talking about. First year, can you get a discount in tax? Talking about everything to do with tax. So it's a free webinar. Come along, get some great information about it. I obviously focused on property, but all this also applies to business for the 39% tax change or for this webinar. Yeah, we've also got a link. You have a free chat with me. You might want a property advisory meeting with me and get some specific advice. We've also got another webinar coming up 31st of May. Are you getting enough cash from rental? So hopefully you've enjoyed that. Hopefully you've got some good information from it. Watch out our Facebook, YouTube, that we'll be putting through more information about this. This is going to come up again and again, especially if Labor stays in power after the election. So hopefully you've enjoyed that, and yeah, check out our Linktree. Thanks a lot. Bye.